I'm going to be teaching you the four most fundamental principles of value investing. Do you feel frustrated by the unpredictable nature of the stock market? Are you struggling to make sense of the confusing world of investing? If so, you're not alone. Many people feel overwhelmed and intimidated by the idea of investing their hard-earned money in the market. Well, what if I told you that there was a time-tested, proven strategy that could help you make sound investment decisions and potentially generate significant returns over the long term? This strategy is known as value investing, and it's been used by some of the most successful investors in history, including Warren Buffett and Benjamin Graham. In this video, we'll explore the four principles of value investing, and by the end of the video, you'll have a better understanding of how to apply them to your own investing process. So whether you're a seasoned investor looking to refine your strategy or a beginner just starting out, this video is for you. Let's dive in and discover the four principles of value investing together. First and foremost, let's talk about the concept of fractional ownership percentage. When you buy a share of stock, you're not just buying a piece of paper or a number that goes up and down on a chart. Instead, you're buying a fractional ownership percentage of a business. This principle guides investors to treat their stock investments as if they're buying the entire business. The financial concept that stocks are partial ownership shares in a business means that when investors purchase stocks in a company, they are essentially buying a portion of the company's ownership. Stocks, also known as shares or equities, represent a proportional ownership interest in a company, which entitles the shareholder to a portion of the company's assets and earnings. For example, if a company has 100 shares outstanding and an investor buys 10 of those shares, that investor effectively owns 10% of the company. As a partial owner, the investor has the right to vote on important company decisions, such as electing the board of directors and approving major company initiatives. They are also entitled to a portion of the company's profits in the form of dividends or by selling their shares at a profit. The value of a company's stock is influenced by a range of factors, including its financial performance, market conditions, and industry trends. If a company is performing well and is expected to continue to do so, its stock price may rise, reflecting the perceived value of the company. Conversely, if a company is performing poorly or is facing challenges, its stock price may decline, as investors reassess the value of their ownership interest in the company. Keep in mind that human nature plays a big part here as well, and things don't always make sense all of the time. To summarize principle number one, stocks are partial ownership shares in a business, meaning that when an investor purchases shares in a company, they are buying a proportional ownership interest in the company, entitling them to a share of the company's assets and earnings, as well as the right to vote on important company decisions. So let's walk through a more concrete example of this. Let's say that there's a publicly traded company called ABC Corporation that has 1 million outstanding shares of stock. If an investor purchases 10,000 shares of ABC Corporation, they would effectively own 1% of the company. As a partial owner of the company, the investor would have the right to vote on important company decisions. They would also be entitled to a portion of the company's profits in the form of dividends or by selling their shares at a profit. For example, if ABC Corporation earns $1 million in profits, and the company's board of directors decides to distribute 50% of that profit to shareholders in the form of dividends, the investor who owns 1% of the company would receive $5,000 in dividends. If the company's performance is strong and its stock price increases, the investor's 10,000 shares could be worth more than they initially paid for them. Conversely, if the company's performance is poor and its stock price declines, the investor's ownership interest would decrease in value. In this way, stocks represent partial ownership shares in a business and can provide investors with both the potential for capital appreciation and a share in the company's profits. Next, let's delve into the concept of margin of safety. Every business is worth the sum of all the future cash flows that they'll generate from now and until Judgment Day, discounted back by some reasonable interest rate. If you can figure out what this value is, then you should pay a price well below it. In finance, the margin of safety is the difference between the intrinsic value of an investment and its market price. It is a concept used by investors to assess the potential risk of an investment by determining the amount of room for error that exists between the current market price and the estimated intrinsic value. The margin of safety represents a cushion that can protect investors from losses if the market price falls below their estimated intrinsic value. In engineering, the concept of margin of safety refers to the difference between the maximum load a structure or component can handle and the actual load it is expected to handle. It is a safety factor that's used to ensure that the structure or component can withstand unexpected stresses or loads without failing. The margin of safety is usually expressed as a ratio of the maximum load to the actual load, with a higher ratio indicating a higher degree of safety. The concept of margin of safety in finance and engineering is similar in that both use a safety cushion to mitigate risks. In finance, the margin of safety is used to protect against unexpected market fluctuations, while in engineering, it is used to protect against unexpected loads or stresses. Both concepts also emphasize the importance of being conservative and erring on the side of caution. In finance, investors who use a margin of safety approach tend to be more conservative and seek investments that have a significant buffer between the current market price and the estimated intrinsic value. In engineering, designers and engineers tend to use a higher margin of safety to ensure that a structure or component can handle unexpected loads or stresses without failing. To summarize, the concept of margin of safety is an important financial concept used to assess the potential risk of an investment. It is similar to the concept used in engineering to ensure the safety and durability of structures and components. Both concepts emphasize the importance of being conservative and erring on the side of caution to protect against unexpected risks and ensure long-term success. Now let's walk through some examples of margin of safety. An example of margin of safety in finance would be a stock that has an estimated intrinsic value of $100 per share. If the current market price of the stock is $80 per share, the margin of safety would be $20 per share, or 20%, as $100 minus $80 equals $20. This means that if the stock price were to fall by 20%, the investor would have purchased the business for a fair price, as the market price would then be equal to the estimated intrinsic value. In engineering, an example of margin of safety would be designing a bridge to handle a maximum load of 10,000 pounds, even though the expected load is only 5,000 pounds. This gives a margin of safety of 100%, as the maximum load is twice the expected load. This ensures that the bridge can withstand unexpected stresses or loads without failing and provide a safety cushion for potential risks. Our third principle is centered around the concept of Mr. Market. Mr. Market is the personification of the stock market and is known for his irrational behavior. Value investors take advantage of Mr. Market's behavior by buying stocks when they're undervalued and selling them when they're egregiously overvalued. Mr. Market is a financial concept introduced by Benjamin Graham in his book, The Intelligent Investor. Mr. Market is a fictional character that represents the stock market as a whole, and he is described as an emotionally volatile person who offers to buy or sell stock every day at different prices. The concept of Mr. Market is used to illustrate the idea that the stock market is unpredictable and that stock prices can fluctuate based on emotional factors rather than rational analysis. Mr. Market's emotions can be influenced by a variety of factors, including economic news, political events, and company-specific news. As an investor, you have the option to either follow Mr. Market's emotions and make investment decisions based on the current market price, or to ignore Mr. Market's mood swings and focus on the intrinsic value of the underlying businesses. Graham believed that investors should focus on the intrinsic value of a company rather than the current market price, and that Mr. Market's emotions provide an opportunity for savvy investors to buy stocks at a discount during times of market pessimism. In practice, Mr. Market represents the collective sentiment of all investors in the stock market. Sometimes the market can be irrational and stocks can become overpriced or undervalued based on emotions rather than fundamentals. By understanding the concept of Mr. Market and focusing on the intrinsic value of a company, investors can make informed investment decisions that are not swayed by market fluctuations. An example of Mr. Market in action could be during a stock market crash or a sudden decline in a particular stock or sector. Mr. Market might react emotionally to this news, causing panic selling and a drop in the stock price. However, the underlying fundamentals of the company may not have changed and its intrinsic value may still be intact. As an investor, you could either follow Mr. Market's emotions and sell your shares at a loss, or you could ignore Mr. Market's mood swings and focus on the intrinsic value of the company. If you believe that the fundamentals of the company are strong and that the decline in price is temporary, you may choose to hold onto your shares or even buy more shares at the discounted price. Another example could be when a company announces positive news, such as a new product launch or a major acquisition. Mr. Market might react positively to this news, causing a surge in the stock price. However, the actual impact of this news on the company's future earnings might not be as significant as the market thinks. In this case, you could choose to ignore Mr. Market's emotions and sell your shares at the inflated price. Or you could focus on the intrinsic value of the company and hold on to your shares if you believe that the company's future prospects are still strong. Finally, let's discuss circle of competence. As investors, we should only invest in businesses that we understand. This principle guides investors to stay within their circle of competence, to minimize mistakes, and build conviction to stay with businesses over the long run. By asking the question, is this business within my circle of competence, investors can partially answer the question of whether a stock is a good investment for them or not. The circle of competence is a financial concept introduced by legendary investors Warren Buffett and Charlie Munger. The concept refers to the idea that investors should only invest in businesses that they understand and have knowledge of, and should avoid investing in businesses that are outside their area of expertise or knowledge. The circle of competence is essentially a boundary that investors set for themselves based on their understanding of different businesses, industries, and markets. The idea is that by focusing on what they know and understand, investors can make informed investment decisions and avoid investing in businesses or industries that they don't understand, which could lead to poor investment choices and significant losses. For example, if an investor has a background in the technology industry and has a good understanding of the trends and dynamics in the sector, they might choose to focus their investments on technology stocks. Conversely, if an investor has no knowledge of the energy industry, they might choose to avoid investing in energy stocks, as they would not have had the expertise to understand the risks and opportunities in the sector. The circle of competence also highlights the importance of continuous learning and expanding one's knowledge and expertise. As an investor, it's important to constantly learn and stay informed about different industries and businesses in order to expand your circle of competence and make better investment decisions. In summary, the circle of competence is a financial concept that emphasizes the importance of investing only in businesses and industries that an investor understands and has knowledge of. By staying within their circle of competence, investors can make informed investment decisions and avoid making poor choices based on lack of knowledge or expertise. An example of circle of competence in action would be a professional athlete who invests in sports-related businesses. The athlete likely has a deep understanding of the sports industry, having worked in it for years, and has knowledge of the market trends, players, teams, and fan behavior. Using this knowledge, the athlete might choose to invest in companies that produce sports media or manufacture sports equipment or sports apparel, as they might have an understanding of the products and how they're marketed to consumers. They might also invest in sports teams or leagues, as they have an understanding of the revenue streams and how the industry operates. However, the athlete might choose to avoid investing in businesses or industries that are outside their circle of competence. For example, they might not have the expertise in the tech industry and might choose to avoid investing in tech stocks or startups. By staying within their circle of competence, the athlete can make informed investment decisions based on their knowledge and understanding of the sports industry, while avoiding investments that they don't understand. This can help them to make better investment decisions and avoid significant losses due to investing in areas outside of their expertise. Remember, value investing isn't a get-rich-quick scheme. It's a long-term strategy that requires patience, discipline, and a commitment to doing your homework. But by following these 4 principles, you'll be well on your way to building a strong and profitable investment portfolio. If you have any questions or comments, please feel free to leave them in the comments section below, and don't forget to subscribe to the channel for more educational videos on stocks, value investing, and more. Thanks for watching, and happy investing.